Welcome to Iraqi Dinar Update, your go-to source for the latest news, expert insights, and real-time developments on Iraq's currency, economy, and financial reforms. Whether you're a long-time investor or just curious about the dinar, you're in the right place. The idea that a country's currency must reach a dramatically higher international rate through a singular, dramatic revaluation is a persistent narrative within some circles, particularly among speculative investors. This concept, however, often lacks the economic foundation and real-world precedent that would make it credible. The belief that the Iraqi dinar, or any currency for that matter, will suddenly leap in value due to some hidden or prearranged international rate reveals a misunderstanding of how global currency markets work, how countries manage their monetary policies, and how currencies integrate with the international financial system. In contrast, let us examine a country like Vietnam, which offers a useful example of what it truly means for a currency to be international and part of the global exchange system, while also being tightly managed and, to many, considered undervalued. Vietnam's currency, the Vietnamese dong, VND, has long been accessible and traded on the international foreign exchange, Forex, markets. It is available on major trading platforms, it can be converted in various international banking systems, and it is recognized by financial institutions worldwide. And yet, despite being fully international in that sense, the dong trades at a rate significantly lower than many other global currencies, often exceeding 23,000 dong to the US dollar. There has never been a sudden, monumental revaluation event for the dong, nor is one anticipated in the same sense that some groups envision for the Iraqi dinar. Instead, Vietnam has followed a steady and deliberate path toward economic modernization and exchange rate flexibility, based on market conditions, trade balances, monetary policy, and central bank intervention. The truth is that Iraq's currency, like that of any other nation, will reflect the health of its economy, the sophistication of its financial system, the depth of its capital markets, its trade relationships, and the confidence that global institutions place in its economic governance. Iraq's efforts to stabilize its monetary system, reform its banking sector, integrate into global payment systems, and build foreign currency reserves are all crucial steps toward greater financial credibility. But these reforms do not imply that a sudden and massive revaluation is coming. Rather, they suggest a long-term strategy of gradual integration, improved transparency, and responsible fiscal management. Any change in the exchange rate would need to be consistent with those goals, not a disruption to them. One must be careful, therefore, when gathering information about the Iraqi dinar and its future prospects. The internet is filled with rumor mongers, unqualified voices, and individuals who stand to profit from dinar sales or traffic to sensational content. These sources often make vague references to hidden global arrangements, secret meetings, or elite financial resets, none of which are substantiated by data or confirmed by credible authorities. They often conflate Iraq's gradual reforms, such as digitizing the financial sector or aligning with international banking standards, with preparations for a revaluation. In reality, these reforms are about long-term financial integrity, combating corruption, and enabling efficient trade, not orchestrating a monetary windfall. Understanding the distinction between a true currency revaluation and a managed, policy-driven appreciation is key. A genuine revaluation in macroeconomic terms refers to a deliberate upward adjustment of a country's fixed exchange rate by its central bank or monetary authority. It is usually done under very specific conditions, large current account surpluses, excessive inflation, or to correct a persistent undervaluation that is distorting trade flows. Even then, revaluations are modest and done in consultation with international partners. For a country like Iraq to revalue its currency by hundreds or even thousands of % in a single move would not only be destabilizing, it would be unprecedented in modern financial history. Further complicating the situation is the concept of a dual exchange rate regime, which Iraq currently maintains to some degree. There is the official central bank rate, and there are parallel market rates that reflect local supply and demand dynamics. Over time, the Central Bank of Iraq has sought to unify these rates and reduce the spread between them, in part by tightening currency auction procedures, enforcing anti-money laundering standards, and cooperating with U.S. regulators on dollar transaction oversight. These steps are part of the move toward greater monetary transparency, not preparation for a speculative currency explosion. The long-term appreciation of a currency is not impossible, of course. Should Iraq continue to reform, diversify its economy, strengthen its rule of law, and build trust in its financial institutions, the dinar could gradually increase in value relative to other currencies. But such an increase would be measured in single-digit percentages over time, not orders of magnitude overnight. And more importantly, such appreciation would reflect real economic gains, increased productivity, export competitiveness, investment inflows, and fiscal discipline. It would not be engineered for the purpose of enriching currency speculators. Vietnam is an instructive example because it has embraced this kind of long-term, steady development approach. The Vietnamese dong has maintained relative stability, supported by careful central bank management and robust export growth. Despite its low nominal value against the US dollar, the Vietnamese economy is one of the fastest growing in Asia. Investors focus not on the face value of the currency, but on the country's fundamentals, its manufacturing base, demographic trends, infrastructure investments, and trade agreements. This is how true international integration is measured, not by the nominal exchange rate. In summary, the belief in a sudden, dramatic international rate for the Iraqi dinar is a fiction unsupported by any historical precedent, economic rationale, or institutional roadmap. While the dinar is expected to eventually gain value as Iraq continues its path of reform and stability, this will occur gradually and in accordance with standard monetary policy tools. Vietnam demonstrates that a currency can be fully integrated into the global financial system, actively traded on forex markets, and accepted in international transactions, all without undergoing a sudden revaluation. When studying the Iraqi dinar or any foreign currency, it is essential to rely on credible sources, understand the macroeconomic context, and avoid being misled by sensationalism or unfounded claims. Monetary policy is a serious and sober affair, grounded in economics, not internet rumors. Thanks for tuning in to Iraqi Dinar Update. If you found this content helpful, be sure to like, subscribe, and hit the notification bell so you never miss a beat on Iraq's evolving financial landscape. Stay informed and stay ready.